Today, we uncover a hidden domino in the financial system. A threat so subtle it hides behind the appearance of stability, yet has the power to trigger a chain reaction that could shake markets across the globe. This is not speculation. It's the story of the invisible forces that move capital, debt, and leverage quietly beneath the surface, often unnoticed until the damage is done. It starts with complexity. Modern markets are no longer simple exchanges of goods for money or stock for cash. They have become intricate networks of derivatives, credit swaps, synthetic securities, and interconnected institutions. Each entity, from global banks to hedge funds to multinational corporations, operates not in isolation, but as a node in an enormous, fragile web. One misstep in one corner of the system can ripple outward in ways that are almost impossible to predict. Consider leverage. Companies and investors borrow to amplify returns, and in calm markets, this works perfectly. Profits compound, portfolios expand, and confidence grows. But leverage is a double-edged sword. A sudden shock, a missed margin call, or a small drop in asset prices can trigger forced selling, cascading losses, and margin calls that hit counterparties one after the other. This is the hidden domino, the point where one seemingly isolated failure can set off a chain reaction. These dominoes are not always visible. Often, they hide in off-balance sheet accounts, obscure derivative contracts, or shadow banks that operate beyond the reach of traditional oversight. During the 2008 financial crisis, instruments like collateralized debt obligations and credit default swaps masked the risk from public view, hiding enormous vulnerabilities behind layers of mathematical complexity. Even after reforms, similar structures persist, disguised under new names, managed by institutions that believe they are immune because they survived the last shock. Technology has added a new layer. High-frequency trading, algorithmic portfolios, and automated risk models can accelerate these chain reactions. In seconds, billions of dollars can move across markets, amplifying panic and pressure in ways humans cannot fully anticipate. A domino that might have toppled slowly now can fall at near lightning speed, taking entire markets with it. Even regulatory oversight is part of the story. Rules designed to prevent systemic failure often lag behind innovation. Financial institutions, always in pursuit of profit, find creative ways to skirt or exploit gaps. Stress tests and capital requirements are tools, but they rely on models built on past data. They assume that the next crisis will look like the last one. History, however, teaches us that crises rarely repeat. They evolve. The hidden domino will not fall the same way twice, and it thrives in the blind spots of our assumptions. Investors and policymakers are aware of some risks. Yet the complexity and opacity of modern markets make it difficult to respond decisively. The signals can be subtle: rising spreads on corporate bonds, unexpected liquidity shortages, or unusual patterns in derivative markets. Each is a whisper of instability, often ignored in the pursuit of immediate profit or political convenience. But ignored whispers can become a scream when the domino begins to fall. This hidden domino does not strike in isolation. It interacts with other vulnerabilities, including geopolitical tensions, currency mismatches, and shifts in global trade. A local disruption, say, a sudden default in one emerging market, can echo across continents through financial linkages. The interdependence of today's global economy means that no market exists in a vacuum. The fall of one piece can tip another and another until the consequences are truly worldwide. The danger lies in perception as much as in reality. Market participants often assume stability because nothing has fallen recently. They equate calm with safety. Yet calm can be deceptive. Like a frozen lake, it may hold underfoot until a hidden crack appears. When it does, the collapse is sudden and total. This is why the hidden domino is so dangerous. It is invisible precisely because we rely on surface indicators that fail to capture the underlying fragility. History shows us examples of these dominoes. Lehman Brothers, Bear Stearns, and long-term capital management were all pieces of the system whose failure revealed vulnerabilities no one had fully appreciated. In each case, the shock was amplified by leverage, interconnected obligations, and rapid market reactions. Today, many new dominoes exist, and while they differ in form, their potential impact is comparable. They lurk in derivatives, structured products, shadow banking, and even in the algorithmic strategies that dominate trading floors. Understanding this domino is not about predicting the exact moment of collapse. It is about recognizing the structural weaknesses, the interconnections, and the hidden pressures that make modern markets inherently fragile. Awareness allows investors, regulators, and policymakers to design buffers, diversification strategies, and contingency plans. Yet even the most prepared participants must acknowledge that some degree of risk is unavoidable. The hidden domino is a feature of the system, not a flaw. Its presence challenges us to respect complexity, to question assumptions, and to anticipate surprises. And so, as we watch the world's markets today, stocks climbing, bonds yielding, global trade humming, it is tempting to believe that everything is under control. Yet beneath the surface, leverage accumulates, contracts are structured, and obligations intertwine. A domino waits in silence, invisible to the naked eye, patiently poised for the moment when conditions align and the first piece tips. We may never know exactly which domino will fall first or where it will strike. But history and logic tell us that one day, one event, small in isolation, can ignite a cascade that no one could fully contain. The hidden domino is both a warning and a lesson. Vigilance, humility, and preparedness are the only defenses against a collapse that, when it comes, will feel both sudden and inevitable. The story of the hidden domino is the story of modern finance itself, a complex, interconnected, and high-stakes system where small choices can have enormous consequences, where stability is never guaranteed, and where understanding the unseen is the only way to navigate the uncertainty of tomorrow.